Okay, good evening, everyone. My name is Simon Mashevich. I'm doing something which I thought I wouldn't be possible, in all honesty, and that's do a joint YouTube and Facebook Live. And I've unprofessionally unmuted myself as well. So good evening, welcome to all. You'll notice this says YouTube Live, but maybe I'm going to change this icon so it says YouTube and Facebook Live. If this works tonight, I'm going to play it back and see how disastrous I have really been tonight, because if it's worked, great, and I can let my nerves go. And if it hasn't worked, then abysmal, and never mind, I will have to play down this in my life forever. So good evening to one and all. I'm going to be doing this session live with you this evening, helping you to reduce your buy-to-let tax as much as possible. So if you are doing a thumbs up, maybe I've got to get my phone out now and find out if people are asking questions on Facebook. Disaster. I hadn't thought about that. My focus has always been on YouTube, so that's where I'm going to be answering the questions. So if you are on YouTube, great, I'll be able to answer your questions. If you're on Facebook, I'm going to have to just think about this of how I can help you. So hopefully you can see me live anyway tonight, and I'll be going through what I'm going to be discussing with you. The focus is very much on SDLT. By the way, I do have my trusty water, so for everyone who should get their water and pens and paper out, please do so now. But I will be talking about stamp duty land tax, which is the awful tax that you have to pay when you are buying a buy-to-let property investment, or indeed if you're buying your own home. I'm going to be talking about both elements, whether you're buying a home or indeed a buy-to-let property investment, and I'll be doing that later on. The focus on this next section is in the news, and this is where I'm going to be talking about what other people have talked about in the tabloids. So this is where I'm going to share my screen now, and I'm hoping it's going to work where I'll show you the news articles, especially on Facebook. And again, I don't really have the tools by me to look at my Facebook. In fact, I've just noticed my trusty phone is beside me, so I will grab that for your Facebook Live messages, if any are coming through at all. So what I'm going to do, and I'm going to share my screen, and before I do that, I have to share my screen on, would you believe, on YouTube via my web. So I'm going to do that, and I'm going to find my Chrome, wherever that's gone. In fact, you know what I might do is just go straight to desktop and hope for the best. So this is it. This is my Chrome now. Hopefully this should be appearing. And I'm going to be bringing that open. Here we are. Good. So let's just go through the app here. Now I'm just going to check on Facebook to see if that's worked. Whilst I'm doing that, I'm going to take you through what the tablet has been saying. As usual, I'll be mentioning who they are by association, and this is talking about the reform for buy-to-let landlords, kickstart property market. And interesting, if you've not read anything by association, please do so. Spend some time looking through their articles. They've got some really cracking articles going on there, so it's worth having a look at their articles. And Eleanor Harvey is the one I always kind of tend to read on a weekly basis, it would appear now. So this particular article is all about reducing stamp duty to land tax now that Boris Johnson is in play, and the question is there going to be any changes? Well, the article talks about something that I've been looking at for quite some time. I'm part of the Association of Accounting Technicians. Well, not AAT is boring, but me being part of that's a little bit boring. But what's interesting about that is the fact that they do talk about the switching of stamp duty and where it should reside. And the question really is well, where should stamp duty land tax reside? Should it be with the seller or the buyer? And it's been an interesting one because the buyer obviously pays the SDLT when buying property. But there has been a call to say, well, hold on, should we change that to the seller? I think that's a disaster waiting to happen if they even did consider this, because it would prevent anyone from selling properties. They've got capital gains tax if it's their own property buy-to-let portfolio, and now they've got their stamp duty, which is normally paid by the buyer. So it would be a disaster for people selling properties, I have to say. But it was interesting. Javid, who is the obviously Chancellor, has mentioned already that the and that's Sajid, by the way, Sajid Javid has said that he's not going to consider this change because it wouldn't be a good thing to do at all. So that just goes to show you that it's not the best option for SDLT. Really, we need to be thinking about removing the SDLT high charges, which is what Boris Johnson has talked about. So let's hope that this is something that will happen. And indeed, let's go on to the next subject, which is talking about this over here, which is letting agent today. Letting agent today was talking about, I just noticed on Facebook Live, see if there's anything going on. I don't think there is. So I've just noticed that my Facebook Live has gone on to just my camera, so that's not a good start at all. I was hoping that it would allow me to share the screen, so that's not really worked the way I wanted it to do so. So I shall try my best to get rid of that. So if I can do my Google here, and let's just see if that works. Okay, I'm just going to go back to my Google. For some reason, my text not works, and that's probably because I'm trying to do a Facebook Live as well as a YouTube Live. Maybe that wasn't such a good idea after all. So let's just talk about this one then. So this paper, this is Letting Agent Today, and it was sort of about buy-to-let has now fundamentally changed because of the law restriction and also the tax changes. And what I liked about this article, it was talking about the different ways that you can look at property investments. But the kind of the thing that drew my attention was right at the bottom of this article that said the yields in certain areas are far greater than obviously the rest of the country, and those areas being Nottingham. Don't buy my area, please. This is where I'm investing. So let's scrub Nottingham and focus you on Manchester and swamp that market instead. But you got Manchester, Liverpool, and the reason why they mention those areas is because they're high yields. So Section 24 and the tax changes, as well as the legislation changes, are affecting the profitability. Then maybe we need to diversify our portfolios and look for more lucrative areas. And that's pretty much what they were saying in this article. And I thought it was a really, really interesting insight in terms of what they had to say. We've got another article that was written by Best Advice, and they highlighted how Coventry Building Society are really fundamentally changing their rates. So one of the rates that they talked about was a 1.39%, which is down from 1.59%, by the way, on a 2-year fixed until 21, so pretty much October 21. And again, interesting, 50% loan to value, so not the normal loan to value that property investors go for, but even at the 75% loan to value rates, their mortgage interest cost is 1.69%, down from 1.89%. So again, we're just seeing a far more competitive marketplace now with the Coventry Building Society, and others will follow suit. But crikey, below 2% on mortgage interest costs, that is phenomenal. So how long this will continue, I don't know. But I would suggest if you have got your buy-to-let portfolio that needs to be refinanced at a point, then do start now. I'm going to go on to this other one, which is talking about, again, Letting Agent Today wrote an article about fines. And this is a slightly different from buy-to-let tax, if you like, or anything else. But the fundamental part of running your property business, which it is a business, is to make sure that you run it as such. So if you've got a buy-to-let portfolio, you've got tenants, they are your customers. So you must look after them the best way you can. Indeed, your asset needs to be looked after. But the Letting Agent Today wrote about an article about a couple, the Chowdhuries, that didn't look after the property. It was in disrepair. And finally, the Mid Sussex Council inspected their property 18 months ago, and now they've got fines up to £140,000. So if you've got a property you're not sure is in good nick, even if the tenant doesn't complain straight away, you have to do your 6 monthly inspections to make sure, one, that the property is good order, your tenants have been looked after. But the third and biggest reason is you do not want a £140,000 fine by a local authority because they deem it to be unsuitable for living in. So do make sure you go and get looked after that regard. An article, I always read the Telegraph, by the way. It's just always an interesting perspective of how they write. But they do talk about, in an article that's headed up Labour's Bolshevik light right to buy plan will hurt landlords, but be worse for renters. And basically what it means is that the Labour Party are now looking at getting their the properties that people are renting, but saying, well, why don't you buy the property you're renting from the council and whoever and buy it below market value, which means they're buying below market. Well, by the way, this happened years and years ago. So 70s and 80s, people living in council houses were able to buy their properties at a discount. I'm not sure if it still continues. I'm sure it does. But this is nothing new. So the fact that Labour Party are now introducing this once more, if they get into power, but probably ramping it up, would suggest to me that they're trying to suppress their buy-to-let portfolio values once more. And I think we have to be honest here that Corbyn is not exactly a fan of entrepreneurial spirit when it comes to property investors. So we do need to be careful of that. Okay, so then we've got another article written by Which, which is very factual in its writing, I find. And this is talking about buy for uni mortgages. And it's something I talked about 2 weeks ago, whereby you have your son, your daughter of age going to university, and what tends to happen is that they go to the or whatever room, dormitories, if you like, with a part of the university. And the second, third year, then they go into a house and they rent. Now, that's quite a cost. You've got to pay for that. The houses aren't really that great. I've got to be honest, when I was at university, that was especially true in Birmingham. Perry Bar, by the way. But what I would be suggesting, and similar to this article, is, well, do you ever think about buying a buy-to-let property portfolio? And one of those properties being for your children. We always think about getting your child on the property ladder. Well, why not start earlier than ever before by getting them on the property ladder? And that way, you've bought them a property, you're not paid for the rent, and they can make money on the property. Secondly, the benefit of this, if they're making money on the property, so their monthly rent is paid for them, and they're getting surplus money, they don't need to come to you every month asking for more money for living. They can actually take that from their property and it will teach them the value of money, you would hope. But that is just one aspect of it. So this is a very nicely written article by Which, and it talks about, is it really worth the investment? And it gives you some aspects of where it can help you, which is reducing costs, which I talked about. And it talks about mortgages, but then it also gave you some downsides as well. So be sure to read that article. And this is Which, and it's called Buy for Uni Mortgages. Should you help your child become a landlord at university? My view is yes, teach them how to earn that money, but do read the other side of the coin by Which as well. Here's another one that I found really fascinating in terms of what came out in the press by the Property Reporter, and it's an inheritance tax, which could be a burden. Now, for many buy-to-let property investors out there, they will be typically getting a mortgage on interest only, which basically means that the debt will forever be there. And at some point in time, it does have to be repaid back. Now, if you pop your clogs and you die, you are technically leaving some assets, but you are leaving a chunk of liabilities as well, which would be mortgages on your home as well as the buy-to-let properties as well. How do they get paid back? Well, it's interesting because this article talks about inheritance tax, which are over £650,000. If you're a couple, any assets over that will be subject to 40% tax. Now, we've got to imagine if you've purchased a property 10, 15 years ago, that property would have increased in value. Now, that's the problem, because if it's increased in value, that would be subject to 40% tax. If the estate doesn't have the money to pay the inheritance tax, what happens? Well, you have to sell your property portfolio. Well, not you, you're in your coffin underground. It's your estate, the loved ones that are left behind. Now, they're trying to grieve for you and get used to life without you. And now you've given them an administration headache, and to a point of fact that they may not even be able to pay off those mortgages at all without going through the stress and turmoil of selling one of your buy-to-let property portfolios. So what do you do? Well, have a read of this article. I'm not a wealth planner. I'm not a financial advisor. I would suggest you speak to your IFA, your wealth manager, to find out how you can safeguard yourself from IHT as a buy-to-let property investor. And that's pretty much, I think, goes, I should get rid of that. I don't need any of these little tabs that I've got on here. So I'm going to just remove this and get rid of that, and that, because I don't need any of those. And that clearly didn't work, so I'm going to get rid of that as well. And we're back to YouTube. So good. So that's pretty much in the news. So if you've got any questions on that, then please feel free to type in the comments box below, and I will be sure to answer your questions on this session. So make sure you do that. If you found something useful, if you kind of was like, wow, that surprised me, then, or if indeed you've got any views on the articles that I've talked about tonight, make sure you get those across and put those in the comments box below. What I'm going to do now is move over to a different a different share now, and I'm just going to go into my PowerPoint. And I have to unfortunately swap my PowerPoint now, so just bear with me a sec while I do that. And then I will talk about stamp duty land tax, and I'm just going to go into that slide now. And here we go. So let's talk about that. Sorry guys, I'm going to have to just stop this for a second because it's not working the way I wanted it to. So just bear with me a second on here, and I will get myself back. Here we are. Haha. So here's my PowerPoint presentation, and it is talking about property tax and indeed stamp duty land tax. And this is where I'll be sharing the next few moments with you about how you can reduce your stamp duty land tax liability. So let's crack on then, and we'll talk about the stamp duty land tax, what it is, what taxes you have to pay, when by, and how, more importantly, how you can reduce your stamp duty land tax liability. So let's go ahead then, and we'll start to go through the slides. If you do have any questions, make sure you type those questions in the comments box below this video or wherever you're finding them, and I'll be sure to always answer those questions as quickly as humanly possible. Don't forget, if you are on our website, Optimize Accountants, you can book a consultation call to talk about the subject matter that we are on now, talk about stamp duty and land tax, and make sure you do that. But let's get into the crux of stamp duty and land tax. And this is, what I've done here is a slightly different table, which you may be used to. And normally you have different rates, but notice here, and I'm going to use my red pen here, my highlighter, here we go. Oh, that didn't work. Let's just try a laser pen. There we are. There we go. So hopefully you can start to see that we've got this, these different types of bands. This is more bands than you're used to, and that's because I've amalgamated the residential rates down there, which includes, by the way, the 4%, the 3%, sorry, stamp duty and land tax surcharge from £40,000 to 125%. So you'll notice that's in there. And I've got something going strangely off on there, but anyway. And then you've got non-residential rates as well. And please do note that you've got this 15% versus 5% stamp duty land tax charge. And that's why people are looking at non-residential rates and buying those type of investments, which I'll talk about later on. But that's why SDLT is pretty much stopping us from investing as heavily as we used to, because of this 3% SDLT surcharge. Never mind the banded rates, which hurts us. And anyway, but I would say if you're an investor, the property investor, you're probably investing up to around about £300,000, which you can see there is about 8%, which is 3% exactly more than the non-residential rates. And that is where the pain comes into it. We do need to bear in mind that the SDLT now needs to be paid within 14 days, not 30 days. That's been a budget change for some time now. And therefore, SDLT needs to be paid within 14 days, and it needs to be completed on an SDLT1 form, either paper or online. Typically, it will be your solicitor that does that for you. Okay, so let's move on. So we're going to talk about stamp duty, land tax now, 3% surcharge. What is it and why that took place? And this is another area where the governments have tried to stop buy-to-let property investors buying properties, which in their view was taking it away from people that want to buy a home. Well, the 3% surcharge is here to stay. I am sad to announce. Well, it's not my announcement, it is the announcement of the government. But 3% SDLT surcharge is certainly something that we need to be aware of. And it is in here your own home. And I'm talking about own home. So this could be if you've got a property as your own home and you then move into another home, you will pay the 3% SDLT surcharge if you do not sell your home, your current home, that is, as part of the transaction. So you will have to pay 3% surcharge. Now, if you sold your main home, let's imagine that you have bought a property to live in, you've still got your existing home, you've paid the 3% surcharge, we know we're going to have to do that. If you sell your property within 36 months, you can then go back and get that 3% reclaimed. So it's not a be-all and end-all. You can retrospectively go back to pay, reclaim the 3% SDLT surcharge if you sell your current home from your new home. Now, you'll notice in here, I've got an exception here. This is 28th of October 2018. If you have bought a property at that date, this is a situation I was in, by the way. I had a home, I sold it, but I didn't then replace the home until after the SDLT surcharge came in, and which is the October 2018 deadline. I then purchased that home before that deadline. Funnily enough, it was September 2018, and I was able to get away with not paying the 3% SDLT surcharge, even though I had a buy-to-let property portfolio, and that is because I sold my current home, my home, as it were, several years before, and I could prove that. So the SDLT surcharge did not affect me. I already mentioned about if you sold the first home and you moved into the second home, the first home was sold within 36 months, you can indeed reclaim that SDLT surcharge. Please do note, if you're transferring a property from your own name to a company, you are likely to be hit with a 15% SDLT charge by moving to that company. So personal name to a company, you are likely to be hit with a 15% SDLT charge. So these are the kind of things you do need to be aware of when it comes to your home and then trying to sell it one way or another. Now, this is where it gets interesting. This is as a buy-to-let property investor. So that was talking about having your own home and having to pay the 3% SDLT surcharge. One thing I should say before I flick over, actually, this is for people that have more than one home, okay? So if you've got your own home, you sell it and you buy another home, you will not have to pay SDLT 3% surcharge. If you have a buy-to-let property portfolio in a limited company and you're renting you personally, and then you buy your own home, you do not need to pay the 3% SDLT surcharge. It's only if you have more than one house in your personal name, and that's irrespective if it's your own home or indeed a buy-to-let. So let's talk about reducing SDLT. How might you do that? And the first thing I would say is you could add up your chattels, and I will talk about that later on. You can buy six plus properties, non-residential rates, and I'm going to talk about that later on. Buy the company instead of a property. How can that help you to reduce SDLT? All will be revealed. And you've got mixed use properties as well. And what I'm going to do first is talk about chattels. Chattels is an item that is, if you shape your house up and down like so, it will be an item that will fall to the ground. Typically, I'm talking about fixtures and fittings, I'm talking about furniture, I'm talking about appliances, that kind of thing. So those items are called chattels, and you do not need to pay stamp duty land tax on those items because you only pay SDLT on freehold property and land. So let's be clear about this. You do not need to pay SDLT on chattels, and let's go through this in more detail. So we're going to talk about add up chattels and how we can do that. So the first thing is, I would say, like I say, chattels is soft furnishings, curtains, carpets. So things that, and now you could argue if you shape your house, you would hope that your curtains wouldn't just typically fall to the ground. But what I would say here is it's not bricks and mortar. So things that are not bricks and mortar of your own home or attached to them, like kitchens and bathrooms, which are fundamentally screwed into the walls, then they will not be subject to SDLT surcharge. So soft furnishing, curtains, carpets, beds, dining table, settee, etc. Even lights and curtain poles, they would not be subject to the SDLT charge, nor the 3% SDLT surcharge. Why am I mentioning this? Well, let's imagine that you're buying a property, a buy-to-let property investment, and you are buying it from a couple that are downsizing. They had a big house and now they're moving to a bungalow. Well, they may be downsizing. They may have items in the property that they just do not want to keep. They'll end up hiring a skip, which is extra money to them to pay out. And you could come in, slave the day and say, well, why don't you keep those items in the house? We will buy it, but we'll just reduce. So I'll do you a favor by not having to get rid of this stuff. And you do me a favor by itemizing it on our completion statement on our property purchase. Now that's great, because what will happen is that your solicitor will say, great, what have you agreed? Well, what will happen is that you would go around the property with the seller and say, which items are you looking to leave behind? What is the value when you purchase those items? So you might come up with, I don't know, £200–300 for the curtains, £400–500 for all the carpets. We're going to leave the dining table, that's about £100, £150, maybe £300. You've got light fittings in each house, in each room, that might be £200–300, and it soon adds up. And what you would have is your solicitor would draw up your completion statement that identifies these items as chattels. The reason why I mention this is this example here. You have got chattels, no chattels being itemized here, and then chattels description here. Now, we might talk about £20,000. We're not going to be talking a great deal. You can't go into a property and say, I'm buying £50,000 worth of chattels and the house is only worth £80,000. You are not going to get this. I have that daft question before, and forgive me when I say daft question, because let's have common sense approach here. I know we're always trying to save on tax, but let's not be ridiculous and get caught out. So the thing is, I would say, is that you'll have a house purchase of £350,000, but if we have chattels at £20,000, it brings down the house price for SDLT purposes to £330,000, which is significant. When you think about SDLT, you're saving £1,600. Now, I appreciate £1,600 isn't the huge amount of tax that you can save here, but it's just paid for your conveyancing. It may have paid towards some of the moving costs that you've got going on as well. So every little helps, right? So that's where chattels can certainly help you. And again, if you've got any questions around this subject, make sure you type those in the comments box below, and I will be answering those questions as soon as humanly possible. Let's talk about stamp duty, land tax, property purchases now. This is multiple property purchases. This is 2 or more properties that you might buy from the same landlord. So you've identified landlords to buy properties from them, and you've come across a deal and they've got 5, 6, 10 properties, let's say, and you've said, right, I'm going to buy some properties from you, let's do a deal. Well, also then you may be able to get benefit from multiple dwellings relief, or indeed, better still, non-residential rates. Let's have a look at what we mean here. So this is whereby we bought 1+ properties, multiple dwellings relief, and then non-residential rates. So let's talk about MDR, multiple dwellings relief. And this is whereby you've got 2 to 5 residential properties will get MDR. Why not 6 or more? Because you get non-residential rates, which is even better. So we'll talk about properties where you're buying it for 2 to 5 properties. And what you would do is that you would calculate SDLT on the average property value. So I'm going to go through an example later on, but if you've got a property values of $1 million, you bought 10 properties, therefore you've kind of got an average value. You would base your SDLT plus a 3% surcharge on that rate, and then you would do that times by 5 to get your SDLT charge. That sounds quite complex, right? Well, that's why I've done an example for you. So what I've done here, I have got this, and it's not letting me drag it. Oh no, this is all going wrong. I need to get rid of this marker for a second, or can I? Oh no, this is awful. I can't get rid of my highlighter now. I'm going to have to press escape on that, and hopefully it will stop. Free. I'll move my camera out of the way. That's what I'm trying to do. Okay, so this is whereby in column 1, I'll put my laser-like highlighter on again, laser pointer. There you go. So here's £600,000 where you might have bought it for one house. And let's imagine that you decided not to buy that one house, but you decided to buy 4 houses for £600,000 instead. Now, what will happen is that you've got an average value of £600,000 on that one property, clearly, but the average value of the 4 houses now is £150,000. And what I've done is I've calculated already the SDLT charges on those. So you can see that there's significant differences on those SDLT bands. Now, what would happen is that you would have this subtotal on the 4 houses of £5,000, which is adding up those 2 values there. And then that gives you your 4 properties, which gives you an end result of £20,000 SDLT charge in total. My laptop's gone really hot also, I'm not sure why. So you are going to be saving £18,000 in SDLT, stamp duty land tax, simply by buying more properties and claiming MDR, multiple dwellings relief, from the same landlord who's selling properties to you. So it's worth you thinking about, instead of just buying 1 or 2, 3, 4 properties from different landlords or in homeowners on Rightmove, why not find someone who's got a portfolio and try and do a deal with them? That way you've got one person and one point of contact to do a deal with, and you can save yourself a lot of SDLT surcharge as well as the SDLT banded rates. And don't forget, 2+ more properties gets multiple dwellings relief, MDR. Okay. Now, I did say if you are buying 2 to 5 properties, this is where you get MDR. But it gets even better if you decide to find a property landlord that wishes to sell properties to you and they've got 6 or more properties. Why? Because you can claim non-residential rates instead of residential, which, as we saw on the previous screen, is a lot of difference in terms of charge. At non-residential rates, you have no 3% SDLT surcharge either, so even better. So let's have a look at an example of how this works. Again, what we've done, you've got £600,000 for one house and £600,000 of money that you wish to invest in 6 houses. So you're going for 6 houses, but ultimately you're putting in the same amount of money, £600,000. Average value, £100,000, you can see there. You've got their non-residential rates. And I've just realized that this screen has not been altered, so forgive me on this, but this is non-residential rates. So the banded rates I'm talking about here would be on the total value, but you do not pay the 3% SDLT surcharge. For whatever reason, my screen hasn't updated that screen, and it's still showing MDR, and it shouldn't have done. So apologies for that. I'm not sure, because that's £1,800 needs to be ignored. So this is whereby you are going to be paying, and I need to flick through my screen to get it back, which is the rates I talked about here. The non-residential rates on that £600,000 would be at 5% versus the 8% that you'll be paying on residential rates. So it is a significant saving for you in terms of buying non-residential rates than it is residential. So forgive me, my screen's not updated. I'm not sure why that is. I will attack it later on with a hammer and need a new laptop because of my angst. Anyway, let's move on from that. And what we'll do, we'll talk about buy a property, buy a company that owns properties. This is instead of buying the property itself. You might find someone who owns a property, but inside a limited company. So you're buying a property from a company, not a person. And that's going to give us even more savings, as we'll explore now. Buy a company, stamp duty is based on equity, not property value. So if you're buying a house from a person, you've got £600,000 house value, £400,000 mortgage, net equity value is £200,000. That doesn't really matter for stamp duty and land tax because you're always going to be basing it on the £600,000. Where a company purchase is slightly different because you do take into account the asset value, but you also need to take into account the liability of £400,000, which gives you the net equity value as well of £200,000. That's really significant because if you look at it from this perspective, and again, it's not updated, my screen is different to my PowerPoint presentation. I need to sort this out for next week so it doesn't happen again. But the house purchase price, you've got £600,000, and you can see the banded rates there and the SDLT surcharge, which gives you a total stamp duty land tax charge of £38,000. And yet, if you're buying a company with a net asset value of £200,000, you'll be paying 0.5% stamp duty, where that £10,000 should be there, but it's actually there already. So you've got that £10,000. You're saving now £28,000 in tax. So £38,000 if you're buying a property from a person, stamp duty land tax, versus stamp duty of £10,000 if you buy a property from a limited company. Significant savings. So instead of going on to Rightmove to find your properties, why aren't you going on to somewhere like Companies House website for you to look at that instead? And you might say, well, how do I do that? And here's a URL. So I'm going to leave this. You can pause this video, I guess. You can have a look at that. But here's the image of this. And it basically gives you a listing of every single company in the country that's registered. And you can identify it by the SIC code, which you can then find properties that are owned in a company. What you can then do is check the assets and liabilities of the company to make sure that indeed that company does own an asset, like a property, and then you can approach those companies to sell those properties to you, which is a great way of saving lots of money on SDLT. Again, if you've got any questions on this subject, apart from my disastrous presentation, not feeding through correctly on YouTube Live, but if you have any questions, then feel free to type those into the comments box, and I will be answering those questions as fast as humanly possible. Okay, now we're talking about mixed-use properties. So this is non-residential rates. So non-residential properties, here we're talking about shops, we're talking about offices, we're talking about warehouses, but we're also talking about 6+ properties, which I've just mentioned earlier. And you've also got a flat above a shop, or indeed a public house as well. So we've got mixed use. That's typically non-residential. So it doesn't need to be just purely used for an office, warehouse, etc. If it's got a residential element as part of the commercial activity, then the whole thing would be considered to be a non-residential property for stamp duty land tax purposes, which you should be already flagging up to say, well, it does not affect me then for SDLT, in particular 3% SDLT surcharge. And you'll notice that I've put these banded rates in here again, because I want to introduce the fact to you that the rates are significantly cheaper for you if you're buying these type of properties. And again, what I've done, I've taken an example here whereby you've got mixed-use properties and not subject to 3% surcharge, mentioned that, but this is whereby we're comparing a £600,000 house versus a £600,000 mixed-use property. So this could be a pub, it could be a shop with a flat above, okay? So those type of mixed-use properties. You'll notice that the SDLT's banded rates are there. I've put the SDLT non-residential rates down below, so you can again see the differentiation of the charges. The SDLT banded rates aren't too dissimilar in terms of the mixed use, but what is fundamentally different is the 3% SDLT surcharge, which is significant. You can see there pretty much that you are halving your SDLT surcharge by buying these type of properties. And I've already said before that you could buy one of these properties and then convert it into you can buy a commercial office, if you like, and then convert it into a residential property. Not only would you be saving SDLT surcharge there, but you could also reduce your VAT rates from 20% to 5% of converting an office into a residential, from 20% VAT down to 5% VAT, which is a significant savings. So you not only saved on SDLT, but you've also saved on VAT as well. I have done a video on this, and I'll drop a link as soon as this video is processed, so you can have a look at that later on. One thing I would caution you on, if you are buying buy-to-let property investments and they are commercial, as in non-residential, you do need to be careful that they do not carry a VAT charge. Typically, when you're looking at Zoopla or indeed Rightmove, you may not see the hidden detail that says VAT will be applied on this purchase. So for non-residential rates of properties, you do need to be careful of the VAT. If they are going to charge you VAT and you bought a property for £600,000, they might lump on a value of £120,000 VAT. Why aren't they telling you? Because they're assuming you are going to claim that VAT back. So it's just an assumed that you are going to claim it, but it's not guaranteed. So you've got a problem, because now you've got a value of £720,000. The SDLT charge is £25,500, which, to be fair, is still cheaper than the residential rate of £38,000 for a house of £600,000. So you can still save SDLT, but you do need to be careful around this VAT charge. Again, you can use Rightmove, Zoopla to find these kind of properties. You do need to look at the particulars of a property to make sure it doesn't have the value-added tax, and make sure, please make sure that your solicitor calculates the stamp duty land tax form correctly on the SDLT1 form, because many do not. If it's mixed use, they do not understand it and try and some sort of arbitrary calculation, which is fundamentally wrong, and charge you 3% SDLT surcharge, or indeed residential rates, which both of them are incorrect, and you'll end up paying too much SDLT. Why do I know this? Because we have several clients that have these type of issues with conveyance solicitors who do not understand stamp duty land tax, which I'm kind of surprised at, but you do need to be double checking everything that they do for you. All right, so if you've got any questions about this kind of tax strategy, then do feel free to drop those comments in the comments box below, and I'll get that to you at some point in the future. In the next section, I will talk about stamp duty land tax for property developers. So I'm not going to go into that tonight, but that is for next week. I'm going to be talking about that. So be sure to stay tuned for Monday Night Live, and I will be on going to take you through that. So what I'm going to do now is just stop my share now and see if there's anything that's gone through our page. If you've said hi there, Kenny, my glasses aren't on, so I can't see. But if you do have any questions, Kenny or anyone else that's listening in, please make sure that you drop those comments box below. There's no questions at the minute, but equally, don't forget to give me a thumbs up if this has been useful, apart from my disastrous presentation that failed miserably. But if you have If you thought this has been useful, then please do give me a thumbs up so that other people can see that this is useful for them, and then maybe they can just see this detail on this video later on after the YouTube has processed it. So that's pretty much me done for this evening. I don't have any questions. I knew I was going to be running an hour. Every week I'm going to be doing this for an hour now. I haven't finished, funny enough, and someone's just left, which is fine because it sounds like I was going to leave. But what I'm going to do is, I've done it in news, but the tax focus is obviously on SDLT today. But next week, I am going to do SDLT for property developers, where you don't have to pay SDLT surcharge at all, or indeed the SDLT banded rates. And then you can see the other subjects that's going to go on as well. So we've got VAT, property tax, CGT, but then there's different types of properties that exist and how those taxes might apply to those different types of investments. I will be doing this each and every single week to help you out. And I've got YouTube Live, but there are no questions, unfortunately, this week from you guys. So now what I am going to be doing is I'm also going to drop in the link below this video once the YouTube has processed this to invite you to our new buy-to-let tax forum, whereby you can learn all about these types of strategies. It's got a whole suite of different programs that you can list onto. I have focused very much on property investing, but I'm going to be doing a lot more on buy-to-let property tax, as you can well imagine. So I will drop a link into that. So feel free to register for this course, and then you'll be drip-fed course content throughout the next few weeks. Don't forget, I'm going to be here again on next Monday evening at 7 p.m. till 8 p.m. And I'll be answering your property tax questions. And again, the focus next week will be stamp duty land tax, but for property developers, where property developers do not need to pay SDLT ever again, as long as they follow what I tell them. So that brings me to a nice close now. So thank you ever so much for joining me. I'm going to just stop my share. In fact, I stopped my share already. I think we have. So yes, indeed I have. So thank you ever so much for joining me this evening. I look forward to seeing you next week. And until then, have a fantastic week. Thank you and good evening.